Hi, everyone, and welcome to yet another risk management debate. I'm very grateful to have Hans with me today to talk about risk management topics. We've picked one in particular, ERM, being the devil in disguise, in my opinion, and something useful in Hans's opinion. Let's, while we're waiting for people to to load and join us, let's test the technology. If you can see both of us and if you can hear properly, do please type plus in the comments section so we can tell that we are well online.
And nothing comes up. There's nobody out there.
No, I can see that there are 16 people out there. It's just that there's a small delay in how we hear each other and how the rest of the participants hear us.
Okay.
But that should be fine. I mean, we will still see the questions. Okay, so the rules for this debate, we will argue a point, we'll go back and forth, sharing some opinions and ideas. The very important message for all the participants is make sure you ask a lot of questions. And don't feel shy. I mean, as I always say, risk management is not for shy people. Do ask away questions. You can type in the questions in the comment section and we will see it and we will respond to those questions, probably closer towards the end of our kind of official debate. Also, there is an option for the bravest of you. I know that there will be fewer, but for the bravest of you, if you have access to a microphone and a video camera, technically speaking, we can let you join us in the video window just like we are, and you can ask your question at the end if you want. If you want to do it, just raise your hand, send us a speaker request, and we'll grant it. So there are many options for you to speak up, and this is very important because we are discussing an interesting topic. It's very important that you do share your opinion. First, I wanted to do a quick intro. My name is Alex Sidorenko. Many years, I think 6 years ago, I had this bizarre idea that risk management information was too closed and too sensitive. So I started sharing pretty much everything I've ever done as the head of risk, as a consultant, and then as a head of risk of one of the government-based venture funds, and then as the head of risk of one of the government-based sovereign funds in Russia. And I started sharing in Russian a lot. My background is Australian, so I eventually, as I left my work in Russia and moved to Spain, I started sharing in English. So since then, Risk Academy has, I think, over 300 articles, 450 videos, 3 books, and 3 games, and some online training, and a lot of other things. Most of those things are free, and I'll share some of that information with you later. If you stick around till the end, till the question and answer time, I will actually give you a free access to the Udemy course that I've developed called Informed Risk Taking. And it's a nice coincidence because I actually stole that name from Hans, Informed Risk Taking. That's what we've discussed when we first met in where was that? Copenhagen?
Copenhagen, yeah.
Where we first met. And it later turned out to be not informed risk-taking, but intelligent. I think it was risk-taking. But I kind of stuck with the original name. So thank you for the idea. And I will give all the participants free access to that training course if you stick around. And Hans will share some links to his work as well. So over to you, Hans. Maybe tell us a little bit about yourself and your background. I mean, I'm guessing most of the people know who you are because you've been quite public in writing different articles in risk space, but do give us the overview of your experience.
Yeah, well, I spent 25 years of my career being blissfully unaware of a concept of risk management. I was doing all other kinds of things until I was asked whether or not we should, or if I didn't think it was a good idea, we got some strategic risk management. I had no idea what the word was all about and what the concept was, but out of the words, it sounded fair enough, so I said yes. And I was asked to spend a day a week figuring out how we could do this in a simple manner because the consultancy report that the CFO had gotten was way off, he said, and much too cumbersome. And that's how I, in 2006, started looking at risk management, literally, physically, by Googling what the heck is strategic risk management. I became the strategic risk manager of the Lego Group in 2007 and held on to that position until April last year, where I decided to be my own boss, which is a lot more fun. A lot less money, though, in my case. But be my own boss and start the company Actus, which is a merge of the Danish words for active uncertainties. And it's based on the philosophy that uncertainties are facts of life. So you may as well learn how to leverage these as competitive advantages. And that's the philosophy I'm working out of, and the idea I have about risk management. It's all about taking intelligent risk taking. Informed is nice. You cannot do anything intelligently if you're not informed, but you can be utterly stupid if you are informed. So that's why I prefer the intelligent. But we had a brief discussion about that.
Absolutely. And before we begin, I did, after the registration, I did ask people to participate in the survey. Do they think ERM as a concept is valuable, and do they use that? And thank you for those of you who responded. Interestingly, for the participants, most of the people who responded said that they don't actually think it's useful. But let me run another survey now. And in your comments section, in a short while, you will see a pop-up that will give you 3 options. Do you have an ERM program right now? And the possible answers are yes, no, in the process of implementing. So please do cast your votes, and I'll share with you the results in a few seconds, and then we'll take our discussion from there. Now, this is, I'll talk in the background while you vote. And again, don't be shy. I mean, there's nothing embarrassing about, and you by the way don't know where we will take this debate, so you don't know what's the right answer, if there is a right answer to begin with. And I will kind of pick up on the discussion. This is really not a first debate where I argue ERM is a total fraud. I've attempted before, and every time I add something to the discussion. So I'll put together my case, and then Hans will kind of respond to that, and we'll see how that goes. So I'll just give you a few more seconds to cast your votes. Okay, you should now see in your comment section, do you have an ERM program right now? Yes, 80%, no, 10%, in the process of implementing 10%. Okay, good. We'll see whether that changes towards the end of our discussion. So let me start off the debate by arguing the case that ERM is not such a good thing. And when I was preparing, I do what I always do. I build a mind map, because that helps me think about things. And the scary thing is the more I think about something, the more alarming the outcomes of my thoughts are. So I think my conclusion and my main argument against the ERM is actually the fact that it's maybe not fair to argue about ERM at all, because in reality the same argument goes for GRC, IRM, integrated risk management, ERM, enterprise-wide risk management, governance, risk and compliance, and probably the other bullshit concepts that consultants will come up with next year, because that's what they do. The real root cause of the problem, maybe, and I think that's what Hans, you kind of alluded to, is maybe the whole problem is not just those specific strategic consulting concepts, but maybe the whole problem is risk management itself. I mean, people been taking decisions, and the tools underlying risk management have existed since 1940s, 30s, or some of the probability theory existed since 16th century. And yet we only started calling it risk management per se recently. And the word name, the name risk management is an oxymoron as well, because we're not really managing risks. We don't do it for the sake of managing risks. We do risk management to help us achieve objectives and to take more informed or intelligent decisions. So maybe the biggest problem is not ERM itself, and arguing against ERM is just wasting our breath. Maybe the problem is risk management itself and the way it was historically perceived. Because the reason why I got this impression, this morning I made a joke about Gartner integrated risk management quadrant, and the joke was, do you think anything in the quadrant has anything to do with integrated risk management? Because basically all the software packages that they've put there, except I think SaaS, has nothing to do with integrated risk management. It's all basic heat mapping, risk reporting type database software, which is all risk management one and useless. And the argument that a few people immediately jumped on the board saying, yes, integrated risk management is a horrible concept because much better concept is GRC. And in reality, I know that GRC is just as bad. It's also a horrible concept. It's completely made up, completely artificial. And that kind of got me thinking that arguing against ERM without acknowledging that the words risk management are fundamentally flawed is just not fair. It's not giving justice to the real root cause of the problem. Because risk management is not about managing risks; it's about informed risk taking. And Hans, what do you think of that? And I'll pick up on ERM later. But just my initial challenge is ERM is irrelevant because the whole concept of risk management is fundamentally flawed.
Well, yes and no. To me, it's a matter of looking at one approach of managing a company, but it's all, or a business entity or some other entity. It is all about different nuances of management. I mean, I don't expect you that you will argue it's all about managing performance. So we don't need people management. We don't need finance management. We don't need sales management. We don't need anything management. It's all management. And you can put everything into its all management box, and then you will have no distinctions and no professionalisms. You still want people with a trained risk background that knows about statistics, knows about finance, knows about how to calculate, knows about decision theory, knows about human biases and so forth, to be the experts to help the executives drive the business. And to that extent, they need to be experts in how to address risks and opportunities or uncertainties in general. And that constitutes risk management. The problem is that it has so far only marginally and in a few organizations been woven seamlessly into the way the company's been led, and it's been attached on, which is nice for a consulting company also doing people management. Here we have this, and we attach that on top of everything else that you do. And of course it's important, and of course you have to pay us $1 million for helping you, and that is the flaw of it. But to me, risk management is just a fragment or an entry point into the general broad management. But if you discard risk management, you could just as well discard human management or anything else.
Yeah, and you actually make an excellent point with finance management being a specific area of expertise, an area of expertise that is unique to finance professionals, because your general production manager may not have that set of competencies. And yet, finance management is used for something. It's not necessarily just done for the sake of doing a finance report. It's not like the finance team sits and generates their own reports, they have their own inputs and outputs. They're integrated into the way business operates. And that's the idea that kind of was probably meant for risk management in the very beginning, where you have a separate set of competencies, well, you have a unique set of competencies, but you apply those competencies to help business make decisions or operate whatever business process or achieve objectives.
Not
You want to
quite.
add something?
Yeah, not quite, because finance is used for something, including leading the company. But then again, the finance industry or finance management industry is so much more mature than the risk management industry is. I mean, they've been keeping books since some monk in Italy came up with the idea 700 years ago.
Yeah.
And that's finance management one, if you may. And then they've turned into strategic finance and decision making, which is finance management two, if you relate it to your terms.
Yes.
I call it operational decision, but still, it's just because they're more mature. It is used for something. To me, risk management, well, when done right, is helping managers taking chances, and in a lot of cases, more chances than they originally thought they would take or would dare
Yes.
to take based on their gut feeling.
I totally agree, and that I think that kind of nicely brings us, and let's use my simplistic terminology. That really brings us to why I feel anybody who pushes ERM agenda strongly is either delusional or a fraudster. Is because there is a very big distinction between risk management 1 and risk management 2. Risk management 1 is your corporate governance dress up. I don't know what the analogy to use. In Russian, we call them Potemkin's village. It's basically a village that one of the ministers built, where he just built the facades, and the queen was traveling and she saw the beautiful facades and she felt like, wow, that's amazing. They've got all the villages are built and they all look great. And this is what the governments, the local governments still do in Russia. They color all the facades for the president's visit. So all the houses look amazing on the outside and look horrible on the inside from the backyard, because they're all colored to make it to appear that like everything is in order. And this is what risk management 1 is all about. It's creating a candy wrap for the business, saying that yes, we have something in place, and here, insurance company, we can send you a report, a bank, we can send you a report, shareholders, we will disclose it in an annual report. And that's one thing. And that serves a purpose. I'm not saying we shouldn't do it. It serves a purpose. It saves money on insurance, premiums, credit ratings, and so on. And there's risk management too, which is all about helping business make decisions and giving them options, validating uncertainties, validating management assumptions, calculating and quantifying different scenarios to assist the decision makers, choosing the best path forward, changing the way business processes operate to make sure risks are properly accounted for. That's risk management. That's risk management too. And in my mind, ERM, everything that kind of comes under the umbrella of ERM is risk management 1. And the biggest challenge I have with the organizations that promote ERM is that I don't know why, purposefully or by mistake, they don't realize it's all pretend, it's all risk management 1. And they continue selling us and promoting it as a solution, as a perfect solution to the actual decision making. Yet, for us who've done risk management for a while, we realize that all this facade has nothing to do with the decision making. In fact, it will probably be the opposite of the decision making, because you would never disclose the real risks that the company is facing, the real risks that are analyzed and modeled as part of your decision making risk management to risk analysis to the insurance companies, banks, and shareholders. You would never show that in the annual report. It's too sensitive. So my biggest flaw with ERM concept is that, in a nutshell, it's all pretend risk management 1, but it is being promoted and sold to the practitioners, and the practitioners are being deceived into believing that that's the end game. Having a overall risk profile is the end game.
Yeah, to me, the problem is that our risk management 1 is silo based. We're dead sure about that, and most of the effects that comes out of it is because the different elements of it, being credit risk or treasuries or whatnot, have perfected what they are doing to save the company as much money as they can within their areas in silo thinking. And there is no way that the head of quality talks to the head of sales about risk management across which may fall over one way or another. It's siloed and it doesn't work. We still need to have the overview. But to me, risk management too has a serious risk of being just as bad. Instead of vertical silos, you will have horizontal silos, and you will look at each decision without looking at the entirety. I don't believe ERM is an overall concept that will help you make decisions, but it's going to be, in my mind, you need some kind of an overview. It's not the end goal. It's not the end goal to have a risk profile and know where it is, but you need to know how much risk you're prepared to take. And you need to know whether you're taking enough risks or taking too much risk. If I was on the board of directors, that would be the first question I asked: how much risk are you taking, and how much risk have we allowed you to take? Based on that, you can discuss methodologies and how to collect data and how to do it from here until the moon turns gray. That doesn't matter. It shouldn't be a risk management one approach. But then again, it shouldn't be a wholly risk management two approach. You need to have some kind of consolidation. Just imagine, I mean, enterprise risk management often uses heat maps because there's so many different things that they try to amalgamate into one. Just imagine your financial reporting, which is stupid. I mean, just imagine that your financial reporting was taking your entire organization and splitting up into small, medium, and large cost centers. And then they have the bad performers, the good performers, the bad performers, the medium performers, and the good performers. And then you simply counted up how many cost centers you have in each of these cells. I believe everybody with a minute idea about finance would find that was a ridiculous way of doing it. So, of doing finance reporting, you need to know, okay, all the shit ahead, what's the bottom line? What's the end result that we get out of it? And I would want to know, as a board member, I would want to know the same thing as a CFO or whoever is in charge of the risk part of it. I would want to know that. And we need to have some kind of systematic approach to doing it. And we may call this, okay, let's call it risk management 1.5, because it's some of one and some of the other. It's not the end goal, but it's a driving indicator or whether we're taking on too much risk.
Well, to that, and I mean, unless business is different in your part of Europe, my impression and the realities of business that I worked in, again, which is admittedly quite a toxic business environment, the reality is the board members would never see the actual risk profile of the organization. They would never be shared how much risk organization is taking. I mean, we can wish they were, and we can kind of write in official documents that they should, but I think I've been in risk long enough to realize that will never happen. Like, there's no chance that the board members or the shareholders or the auditors or the audit general or anyone outside of the management, very closely knit community of managers, top managers, would realize just how much risk the organization has taken. And if you're over,
then let's stop there. Say, okay, this is done for this consolidation is done to serve the top management to know whether they're going to be in trouble or not to be in trouble.
Yeah, and that's fine.
Then forget about all the other things. I know financial reporting is just the same thing. I mean, auditors, external shareholders, and anything, nobody else, they get a very nice nicest painted picture you can out of the annual report. And there's 100 and 1,001 issues below that never hear about, that management is fully aware of.
Yep. And that, like, once we're over that hurdle, and that's why I think quite. I can't think of the word which is not insulting. I think people are a little bit naive on the LinkedIn. There are other people who constantly write, shareholders are a major influence on how risk management should be done, and board members expect this. I never cared what board members expect, because I knew the management would never disclose the real picture. So my customer for the risk professional inside the organization is always the management, the board, the executives, and the CEO. And continuing your point that surely they would want to see the overall risk exposure. And I'm saying, yes, that's fine, but that's why we have business plans. We have a management business plan, or an annual budget, or a 3-year budget. And once we do risk modeling inside that budget or inside that model, that highlights all the liquidity issues, it highlights all the different risk events, it highlights the probability of achieving the objectives, it highlights what the cash deficit may be in what year. Risk, and that's risk management too. It's just risk management too is applied at different levels of decisions.
That requires that you have an organization that is rather easy to overlook or to oversee. I mean, the Lego Group at least is too big, that I've been working with, is too big to do budgeting in a spreadsheet, to do strategic planning in one spreadsheet. It'll be 7 or 8 different strategies. And what's the link between these? And some of the risks that are deliberately taken in one strategy is totally no-go in another strategy, but the two executives never talk to each other about that, and they never think that. That is the value of ERM, is to have somebody take that thought and say, hey, are you aware of this and that? And so, oh, you cannot live with this result, but they're planning for it over there. So this is where we need to combine the things, and we need to model it to a long extent. Yes, but trying modeling 600 cost centers is totally flawed. You can't do that, and the budget is not made based on a spreadsheet. It's made based on an overall set of guidelines that is then cascaded down and then spread into thousands and thousands of lines of entry into a IT system, and then you can extract it if you want to and do some kind of consolidation, which will be harder. The consolidation part is harder for risk management unless you have actually using Monte Carlo simulation on top of it. So I think
which would be the right thing to do.
Yeah, I mean, the real challenge for us could be that what we need to get rid of is the idea that a budget is one sales number, one cost number, and one bottom line number. It's a range, and there are uncertainties to that range. I mean, executives do it already. When they go public, they say earnings per share is going to be somewhere between 250 and 270. They never said it's going to be 262. It says 250 to 270. And the market, the traders say, okay, it's 250. And the shareholders say it's 270 and forget about the 250. And management hope to get somewhere in between, probably well above 250, because then they'll be applauded by the markets. But those are the kind of things that we need to build into the way every project, every decision, every budget is made, resource allocations and so forth. Build the uncertainties in it. That will also allow us to get rid of the term risk in risk management on a day-to-day basis.
Yeah, I absolutely agree. And it's an excellent point that at the end of the day, ultimately, what risk management is all about is changing the way decisions are done. Decisions about the future are not single point estimates. There's nothing single point in the future because the future is uncertain. And the way to think about the future is, of course, to think about in ranges, and ranges based on assumptions. And assumptions have certain behaviors or distributions, and that's what risk management is all about. And changing the way planning or investment decision, operational decisions are made to shift from single point estimates to ranges, that should be the ultimate goal of risk management. What I sense is easier, however, is not to call that ERM, but to forget ERM ever existed and say ERM is just risk management 1. And let's spend 10% of our time on doing this ERM type activities, because it's actually easier to teach people something new about ranges, and it's actually not new. I mean, because scenario analysis has been used for over 50 years. It's actually much easier to jump on the bandwagon of scenario analysis, what finance has done, and scenarios in general, which is kind of natural for human beings to understand, than to reteach all the board members, all the executives, all the 99% of the risk managers who still think ERM is doing a quarterly risk profile, having risk mitigation plans, risk owners, and keeping that up to date, and that being the end game. My argument is that it's much easier to say all we're trying to do is add volatility to existing business management, as opposed to re-explain that, well, actually, that's supposedly what ERM was all about. In fact, it wasn't what ERM was all about, because ERM was created by PwC in 2004 in the COSO ERM framework, and it was not that. This is why I think ERM is such a fraudulent concept, is because it was actually created as an updated risk register. That's what it was, and we kind of, because it was so vague, we now thought that, well, let's assume ERM is that. Let's assume ERM is this. Let's assume ERM is something else. There's no guidance to say what ERM is. It's this vague concept that morphed into a horrible idea of having an up-to-date risk register. So my argument is, why kind of stick and continue riding on this toxic train? Then instead, what we're really trying to do is some very simple, very basic variability analysis of scenarios that finance has been doing.
You want to go in with a very simple, very basic, new way of doing the things they should have done, and come up with another BS concept that shouldn't be BS. You don't believe it's BS, but PwC will.
No, not at all. Not what I'm trying to say. I'm trying to say is that every CFO knows what scenarios are. All I'm trying to say is talk to the CFOs and convince them to outsource scenario analysis to the risk managers. This is what my CFO did. I came to the CFO and I said, you're doing 3 scenarios, we can do 10,000 scenarios in the same amount of time. And that will provide better insight. He outsourced all of his scenario analysis to us. And that's it. That's it. That's risk management too.
That I agree on. It's amazing how often executives making decisions, if it impacts legal decisions, they will turn to their lawyers and say, what is the meaning of this? If it's technical, they will go to the engineering people and say, what are you doing that? If it's involved finance, which is literally always does, they will go to their finance and please calculate this through. And for some of the odd reason, no, not that odd, they will never go to the risk managers and say, what are the risks about that? Because in their concept, very much thanks to PwC and the Sarbanes-Oxley Act, they think that risk management is about compliance, and somebody came up with the governance, risk, and compliance, which is the worst term of all terms. Making
I know who came up with that. And he's a good guy, but he made a mistake.
Yeah, it's a tick box exercise, or makes it a tick box exercise that has the sole purpose of letting the executive say, I didn't do it. I have all the risk management I need, and here's the documentation for it. It wasn't my fault the company went down. Maybe it wasn't your fault. It's your responsibility. You're leading the thing.
Exactly, and this is what I've been trying to say. I even have I do a lot of videos, and I did a video on risk management 1 versus risk management 2, and the video on risk management 1 was super easy. It's basically whatever somebody else's wants, and no matter how stupid it is, just do it. Unless you're like me and you want to go to the government agencies and fight the fight and abuse them for requiring risk management framework documents, which of course is silly. Just do whatever they want, spend as little time as possible, and that's risk management 1. But when I started shooting the video for risk management 2, I almost immediately stopped, because risk management 2, I mean, I call it that, but it doesn't exist. There's no risk management 2. It's not a real thing, because risk management 2 is cognitive biases, which is risk perception. That's research, 2 Nobel Prizes, has been happening since 1970s. Corporate finance has nothing to do with risk, has been around for decades. Probability theory has been around since 15th century, nothing new there. And understanding the nature of the business, again, which is your engineering, pharmaceutical, or whatever degrees. Risk management 2 requires you to understand the way business operates, the basic mathematics, statistics, and corporate finance, how to model stuff, and the human nature to understand how you interact with people, because otherwise they will just lie to you about assumptions.
And that is probably the last one, probably the most difficult. For one thing, there seems to be, every time I look up, a larger and larger number of biases. So yes, I have given up figuring out what they are, because at some point in time it was 10, then it was 25, now it's 100 and some, and I can't remember those. There's no way I can remember those. So I will just pick the few of them. And one of the issues that they have sorely forgotten is the issue of politics, corporate politics. And there's nothing bad about corporate politics, let's just say that. But politics is what happens when you agree somewhat on where you are, you have a reasonable agreement on where you want to be. At least you want to perform better. You're not necessarily 100% agree on what better means, but you are somewhat aligned on where that is. But there are different routes you can take. You want to grow your company. Great. The sales guy wants to go into new markets. The product development wants to go into new product categories. And the head of manufacturing wants to keep the whole thing as simple as possible. Now, they don't agree on which path to take to get a stronger performance going forward. And that's perfectly legitimate. So what they have is this trade-off balance, which means that sometimes an executive committee will deliberately take the third best choice because the guy advocating the third best choice hasn't gotten his way for a period of time, and it's his turn if you don't want to piss him off or keep him out of the company and alienate him to the rest of the, because it's a teamwork. So you work together as a team and you give in on issues. Politicians, of course, are very good at that, and some of this they're doing it all the time, and they're professional at it. But executives are just the same thing. There's nothing bad about it. There's nothing sinister or illegal or anything else about it. It's just the way you do things when you do not agree on what's the best way.
Absolutely. And I mean, I'm probably a little bit less optimistic. I've seen some sinister things, a lot of sinister things. Nothing illegal, but definitely questionable.
Russian government fund, I would imagine.
Absolutely, it was super toxic, and that's exactly where risk management comes in, because we had a couple of political projects where the company would invest in a certain technology. For example, somebody had to do solar generation. Somebody in Russia had to start investing billions in solar generation because otherwise the oil economy would never be diversified. And it was bound to happen. Same with wind. Somebody had to do it, and our fund was kind of selected as the victim. So we had to do it no matter what. But how we invested, at what speed, what projects, what did we specifically write in contractual obligations, what partners we selected, none of that was politically agreed. So that's where we've done our risk analysis. We've given options, we've calculated different scenarios, and help management understanding that the end game is not going to change, but the way we get to that end game has multiple different variabilities. And risk analysis helps understand what they are and what the implications are for each path that the management is taking. So it's interesting how we kind of move into this discussion. I mean, unless you see it differently, but I am beginning to realize that there's this corporate governance piece which just has to happen, and hopefully will happen quickly and painlessly. And in fact, I argue that risk managers should be brave enough to update risk policies, frameworks, appetite statements, risk registers, risk reports, mitigation plans, and everything else by themselves, so they don't distract business people from actual work. Because none of that matters. It's risk management one, so it doesn't actually matter what's inside as long as it's kind of reasonably okay. That's my argument. And I can come up with a risk profile for any organization in a day. I've tried it a couple of times, and nobody ever questions what's inside because nobody cares, because everybody realizing that it's not real. But apart from risk management one, the kind of the value, the potential value of risk management, and I think calling it ERM only devalues it, because ERM has this baggage, and it still continues, because if you Google ERM, what you will find is an ERM page on Wikipedia and ERM Initiative, which is an organization in US led by the North Carolina State University, and a couple of people I've met in Milan many years ago, and they publish a lot on ERM. They're like the think tank on ERM. And every single video, every single publication that they publish is absolute bullshit. It's nonsense. For them, maturity in risk management is updating risk inventories. They even seriously, right now in 2018, they use word risk inventories. Inventories. I don't know what's the right pronunciation is. I mean, this is just beyond comprehension. How can anyone still think that updating a risk register is in any sense good risk management? But anyway, that's what we have to deal with. So ERM has this whole baggage, even now, of a lot of toxic information. And maybe maybe instead we should be saying that risk management 2 is actually doing risk-based budgeting, risk-based strategic planning, risk-based investment decision making. And in every single case, that would be actually a different risk management per se. And that's, by the way, and sorry, I know I'm jumping back and forth between my thoughts, but that's why I think ERM is also quite a stupid concept, because it assumes that you should have a single enterprise-wide methodology for risk management with a single set of criteria, which of course is nonsense, because in procurement you would have one risk management methodology, in budgeting you would have a different one, in investment planning you would have a different one, in price setting you would have a different one, in production and maintenance forecasting you would have a different one. In fact, you would have multiple risk managements in the organization if you are doing it correctly.
To me, the good way of doing enterprise risk management is to say, okay, there are two things that I'm looking at enterprise. One thing is the overall exposure, which I still like to inform the executive committee on. Are we in trouble or are you not in trouble? That's just a simple speedometer. You can drive 100, you're currently doing 65. Okay, I'm good, no worries. That's it, and nothing more than that. The second thing I think it should be is a channel from which specialists from around the company and risk managers as well can convey emerging risks, changing risk landscapes, changing this or that, so they can be fed in and say, okay, dude, we have this strategy, we have this approach, but this and that is happening, or this or that indicator that I have chosen to monitor is changed to that extent that now we use the enterprise risk management as a case-by-case reporting on driving change, driving decisions that would otherwise not have been made because they're not within the realm of the strategy and nobody's looking at them. And let's face it, strategy is something you do rather rarely. What you do is executing. And when you're focused on executing, you're not looking at the outside world. You're just focusing on getting it done right. So you start picking your own navel rather than look outside. I want the enterprise risk management to be the risk manager's look outside his toolbox, his approach, to be able to inform risk executives in time. And I don't need another word for that. I just don't need anybody else. It's the risk manager's tool, and he doesn't have to call it risk management to enterprise risk management for anybody else. He doesn't have to talk about it for anybody else. It's just like treasury and controlling and everything. They also have a lot of different internal jargon that they're using in their own minds, and thankfully don't ever talk to anybody about, because nobody would understand what they're talking about. So it's the same thing.
It probably is. And now that we have about 15 minutes left, and I mean, if you're okay, we can maybe stick 5 or 10 minutes after if we have questions coming in. And by the way, do start sending through questions. Paul asked the first question, so I'll read it out loud. If you're starting from scratch, does it make sense to start from risk management 2 immediately, or should still do risk management 1 to begin with? I'll give my opinion, and then you can add to that, Hansi, if you want to. My opinion is that risk management 1 is usually there because somebody expects it to see something. So first, when you're starting in risk management in general from scratch, you have to understand what the law says, what the corporate governance best practices, what the stock exchange listing requirements are, what the external auditor expectations are, what the state auditor expectations are, and what the insurance companies and external financing providers expectations are. And what you will realize is that most of them, one way or another, mention a risk management policy, a risk management framework, and potentially a risk report. So you probably don't have much choice but to do these 3 documents very quickly, realizing they're not real. You can do it yourself. If you ever have to come up with a risk register, just Google your company's competitor website, go to their stock exchange listing page, and find 10K report if they're listed in US. And 10K report is basically like a summary of risk register, and all companies in US have to provide them. They're all bullshit. But it's the same, by the way. Yeah, they're all the same, obviously, because that's how risk management 1 is. It's not real. And you just copy paste it and you've done. Like, it takes 15 minutes to do risk management 1. And same with policy and framework. Google it, download it, make some changes to make sure the word It references ISO 31000 2018 and COSA ERM 2017, so it's relevant, and that's it, you're done. And then, of course, focus the other 95% of your time on risk management too. And I've just written an article called 5-week challenge, how to integrate risk management too. I'll send a link in a second. I'll send a link in the chat. What do you think, Hans?
Yeah, well, if you're starting from scratch, you have to be a startup company. If you're not a startup company, but you're coming into it, you will probably find when looking around that most of the risk management one is being done already by somebody. Let them go about, do their business, and focus on the risk management, as I call what Alex calls risk management too. Focus on the decisions and focus on where you can get impact. Find somebody in the executive team or the VP layer just below, somebody who will actually buy into learning, buy into doing risk intelligent or intelligent risk taking, and help those guys going through the assumptions, going through the situation, going through the decisions, and give them all the help you can to make it as good a decision and a nuanced decision as you possibly can. Know where to be agile, know where you can allow yourself to be fixed and efficient, and where you have to be agile and effective. And do that and make that guy succeed and help him succeed again, and find another guy and let them be your advocates, and that way roll around the company from success to success. Will you ever have a failure? Not much. Not much, because there's so many decisions made that are a lot of failures, big failures, because the risks haven't been considered and haven't been dealt with. That if you have even marginally looked at what are the uncertainties of this decision, there's a very slim likelihood that you'll actually be caught in doing worse than you would have done without risk management. Technically can happen, but it's not going to happen within your first couple of years, and then you're up and running.
Yeah, exactly. And I mean, human fear is understandable, and risk managers are very scared of being fired. Is that CFOs will tell them to get lost, head of strategy will tell them to get lost, and they may, but none of that is career ending. None of that is deal breaking. I mean, you don't succeed integrating into one strategic decision, you just go to another one. You integrate into, I mean, it took me 3 years to integrate into the overall business plan, strategic business plan for the company. In that time, while I was waiting for the CFO to kind of grow up and accept that Monte Carlo simulation would be more useful to the decision makers than his 3 scenarios, in the meantime, I've done dozens of investment decisions that prove that it was actually a worthwhile exercise. So there's nothing to be afraid when you're asking or inviting people to try out risk management too.
When we did when I did the strategic scenario thinking or strategic planning, at first, in the first half of the strategy process, it's not about numbers; it's about directions. At least the way that we used to do it. So there was no calculating, there was no Monte Carlo simulation, because there's nothing to simulate on. There was no numbers. It was all directional. But what we did, or what I managed to get away with, was to introduce a scenario process as a workshop where the executives were defining their own scenarios and coming up with their own issues and prioritizing those, which was a half-day session, which means it was short and to the point. It was a lot of fun. It was also hard work, but it gave them some insights or some aha moments where they say, maybe they never thought about that. I mean, in one area, they had a decision, they were looking at scenarios, and they were talking about one of the issues they came up with was automated processing, digital automated processing. And it came up in all 4 scenarios. And it came up and say, this is going to happen. And then the head of the functions looked at that and said, this is kind of funny. All 4 scenarios, as an act issue, we have automated processing. That's not part of our strategy. Okay, maybe we should change the strategy because this is going to happen. We know that. We are now aware of that. So they actually changed the strategy based on that. And then we added the numbers and the Monte Carlo simulations, all that brouhaha afterwards. But we had these scenarios where we explicitly push them to think out of their comfort zone, because the 2025 is not going to be in their comfort zone. Sorry, guys, the world is going to change. Everybody's talking about how volatile the world is at this point in time. But sorry, guys, in foreseeable future, it is never, ever going to be as low as it is today.
Yep.
So get used to it, learn to live with it, leverage it.
Yeah, absolutely. I'm moving on to the questions. Now, Christine has an interesting question. It's a little bit more difficult to respond in a short time frame. So I will first address Harold's question because it's easy, and then we'll come back to Christine's question. So Harold is basically asking, why can't we just be transparent, and whatever we come up with in risk management too, we put it in the risk register and send it to the board? I mean, I guess it depends on the country, but I'm yet to work in the country where the objectives of the board and the shareholders are the same as the objectives of the management. And that's why board sets the kind of the limits and the guidance for decision making for the management to control the management, because the management will always aim for their own personal wealth first, and that's their ultimate objective, is to make whatever decisions to make them richer. And the shareholders have a different, they want the shareholders to be richer. So anyway, there are basically very conflicting agendas, and the management will never be honest and transparent with the board because they have very different agendas, and the board has power to change the management. So that's what I've observed.
I have the solution to that one. The Lego Group is family owned. The board has, the top management team has no shares, and are not getting no stock options or anything like that. So their wealth is depending on what the board is going to pay them and nothing else. And they will only look at the wealth and the sustainability of the company based on what the owners want. And the owners are represented on the board of directors. So we have the shareholders and the board of directors setting the entire deal. And maybe that's the solution, to get rid of these very greedy executives, is take the greed away, the base for the greed away.
Maybe.
Option.
It's whichever way you look at it, it's a very, I don't think there's an answer to that necessarily, because this is a very big challenge. The board has a different agenda, shareholders has a different agenda. I mean, the shareholders and the board usually have different agendas as well, because some of the board members are paid employees and they're only paid for once a quarter meetings, and to expect from them any serious commitment is a bit of a joke. And then there's management, and corruption is real, basically, and it's part of our daily life, no matter how much we dislike it. So the reality is, I haven't seen a management team that will say, yes, we're going to disclose the fact that there is a 80% probability that our company will go bankrupt in 3 years. No management would ever send that message to the board members. They will continue dressing it up until it's probably too late for the board members to do anything. That's the kind of the unfortunate reality. Now, Christine asked a very interesting question, and I've experienced that. She's basically saying we're discussing risk registers with the board members, and the discussion itself, rather than the content of the risk registers, is with the senior management, and the discussion is the valuable one rather than the actual content of the risk registers, and that discussion brings a lot of value, blah blah blah. Fair enough. I can only share my personal story. I had a project which was the biggest solar generation factory plant company in Russia, and for 3 years we have been discussing the heat maps and the risk registers with the senior management, and every time something valuable came out, every time the discussion was worthwhile, because that's the nature of communication. When you talk about something, people brainstorm together, something valuable will always come out. The only problem happened is that when we started modeling, when we grew our maturity and we started modeling the different scenarios and the different mitigations, we realized that the company was going to go bankrupt in 3 months, and none of the mitigation plans that the management had signed off for 6 years, or for 3 years, had any chance of working, because we modeled different scenarios and we realized that the company is doomed unless the legislation in the country will change. And that was never on the mitigation plan. All I'm trying to say is that, yes, there is value in discussing, but you don't realize how much more value is in proper risk analysis. Once you switch away from risk register, once you've done any basic risk analysis, even a decision tree, or a scenario analysis, or a sensitivity analysis, or a Monte Carlo simulation, the amount of insight that you get is maybe 10, maybe 100 times more than discussing a risk register. Plus, to add on top of that, the research into heat maps and cognitive biases suggests that most of the things we have on our risk registers, which are based on purely qualitative discussions, are not real. They are perceptions, they are misconceptions, they are somebody's somebody trying to deceive the management or the board. There's a lot of subjectivity in discussing risks in terms of words, and that subjectivity is automatically translated into risk register, no matter how hard you try. I mean, for years I've tried to make the risk register the most amazing risk register I possibly could, only to realize that the human nature is too strong. It's not going to capture the real issues, and the real issues are usually so much more worse than whatever you have on your risk register, that all I can suggest is give proper quantification a try, and be amazed how much more insight, how much more ammunition you get for the conversation with the decision makers.
And I concur on that one. One of the biases that we have is the confirmation, or the bias of overconfidence, where we believe, okay, we have targeted next year we will reach 150. And we are very happy about the 150 and say, what's the downside? Oh, maybe 145, maybe 140, but that would be a disaster. What's the upside? Oh, we could go to 160. If you then go back and look at past projections and past actual performance, you find that the 150, that's plus minus 30. It's somewhere between 120, 180. The volatility you have in the actual data are much bigger than what you think they were. And that's to get that to discussion in and disclose that, have that insights, and you can do that as risk manager. Develop that insight, get the data, look at the volatility of actual performance in the past, and then bring that into discussion. Say, hey guys, it's very nice you're discussing an upside or downside of 5, but the real terms is 30. Now, how are you going to deal with that? How are you going to make sure that you can capture the upside of plus 25 and don't go bankrupt if it's minus 25? Now we have a discussion that really takes some sacrifice. And now we pull them out of the comfort zone, and now we add value.
Yeah, absolutely agree. And while we are talking, I've shared in your comment section, you should now see Hans' book if you want to click on the link and go and read it. He's sharing some of his experience in the Lego group and integrating risk management into strategic planning. I will now move on to the next question. Ben asked a really good question. How do you pivot from risk management 1 to risk management 2, given that risk management 1 has been happening for years and the company's kind of got used to it already? And again, I'll give my very quick response to that. The best what I've worked out is scale down as much as possible on risk management 1. For example, first of all, I'm actually pretty transparent with the executives I work with. I go to them and I say, this is risk management 1. This is basically rubbish. And do you want us to do it for you? And I'm yet to meet a single executive who would say, no, I want to continue doing the risk workshops. I want to do the risk register updates, continue sending it to me. Basically, the reality is, I don't know if you realize that or not, but everyone hates updating risk registers. Everyone in the business hates doing risk management 1 because they're not stupid. They realize how useless it is, how little impact it has on their decision making, on their budgets, and on their performance management. So every time when I come to the executives and I say, would you care if we took this back from you and we took care of it, and we would update all the risk registers ourselves, and we would still send it to you for validation, and you can add whatever you want, but you won't have to do it yourself, and you'll free so much time. And every single time they said, yes, we would love that. And once you free up their time and free up your time, because doing it yourself is much quicker than having the workshops and discussions with the business, then just pick. I've sent just literally 2 comments below your comment. Is an article which says step by step how to do it. Pick a decision, and exactly what Hans was saying. Pick a friend. Give that friend something that is useful to him. For example, my first risk integration was to help protect a vice president from a state audit. I helped him justify his investment decisions using risk analysis to show that that was actually a decent investment decision at the time. Just pick a friend, pick a decision, integrate into it, and then kind of roll on from there. Hans, what do you think?
I agree. Pick a friend, and if you're not looking, if you don't know where to look for friends in that context, try engineering. Technical people seems to be more technical in their mindsets and more probed to be, if not aware of their biases, then they are more to over supersede their biases if they have some factual knowledge, and they will be more likely to buy into it. It's not that it's every time going to happen, but in my experience, engineers and technical people are easier to deal with, and they have the same level of uncertainties as everybody else. My luck was that I was involved in a couple of business projects where I was able to save a ton of money by, should we say, making sure they didn't go the bad way that they were about to go. That is to say, one of the projects I was involved in, they just plowed along and lost a lot of money, and then we redid it, and they didn't lose, they succeeded. The other one, they stopped before they started losing money on a big scale. But that way, I kind of documented the value of going into this, and I was actually called for, my team was called for to go in and help on business projects, and making sure that we had the risk management to the decision process, and we knew what the risks were and knew what we were doing about them.
Mm-hmm. Yep, absolutely. Next question, and this is the last question that I see. So if you want more questions asked, please type them now. Last question: how do you audit risk management 2? By reperforming all calculations done by risk managers. Thanks, Medina, for the question. I think I've answered that question to you before. I don't think it should be done by remodeling the decisions done by the risk managers. I think auditing risk management 2 should be looking at how decisions are made. And I'm actually sorry, I'm in the background. I'm looking for the video where I've specifically answered that question. Okay, here it is. Auditing risk management. And I'm posting the video now. That gives my kind of response, and Hans will give his response. How would you provide assurance over risk management 2?
I would look at what was actually done and executed as compared to what was decided to be done. If you have a risk management 2 process and you decide to do this and this and that to make sure that you have mitigated those and those recognized and calculated and stuff like risks, and then you go through the process and nothing has happened, well, okay, then you have something to report back as an auditor. But what audit cannot tell whether it's stupid or right or wrong. They can tell whether it's done as decided. And if decided to do something, that's in most cases a legal decision. Of course, if it's illegal, it's a different story. But that's a legal and valid decision to make. Okay, you make that decision. Now show me that you're sticking to your guns. And by the way, Alex, I can't see the link to my book yet.
I think that's because we as speakers don't see the links at all.
Okay.
But the rest of the participants do.
Okay.
Any more questions? Now, I promised to give you access to the Udemy course for free. So now it appears in your chat window as well. If you click on the link, that should hopefully, that's the idea, that should take you to the page with the discount code automatically applied, and you should be able to sign up. And if you do sign up, make sure you leave some feedback. You send a message back saying, you put some stars and you write something meaningful, because 100-something students already participated in the course, and I want more feedback to realize what else do you want added to the program. Any more questions? Last chance. more questions. Who has read my free book on risk management? If you haven't, here it is. 40,000 people have downloaded it so far, so it's probably worth a read.
At least I haven't read it yet.
It's, well, this is just how groundbreaking it is. It's all about risk management too, and the book has been written 3.5 years ago.
Yeah.
And I only came up with risk management 1, risk management 2 last 2 months.
Yeah, you needed some distinction between what was it? What's risk management 2 not? And this is, yeah.
Yeah,
Or
exactly.
what is, at that point in time, what is risk management not? And then you came up with risk management 1. And then, yeah. And I looked at it and I wanted something more decisive. So I split it up in what I call execution risk management and decision risk management.
Yeah,
it's all semantics.
Naturally, it is. I actually, interestingly, I've spoken to quite a lot of executives, and again, this is so bizarre. The only people who kind of don't get the idea immediately are the risk managers. Like whenever I have risk managers and executives in the room, and it's fascinating. Like I talk about risk management 1, rubbish. Let's do it quickly. Risk management 2 for the decision making, and I always premise it by saying it's going to be controversial. It's going to be the opposite of everything you've ever heard about risk management. And every single time, a CFO or a head of productions or a head of contracts or head of legal, he goes, makes total sense. Like this, I have no problem with the concept. And the only people who always have a problem are the risk managers in the room. They start arguing and saying, but no, risk appetite is so useful and valuable, and no, we still have to have that. And anyway, they come up with all sort of weird arguments. Now, I did see somebody wanted to speak up and join as a video. If you do, sorry, I may have missed your request for a little while. I've just noticed it. If you want, just send it again. Ben suggesting to rebrand it to RM 1.0 and 2.0. I don't think I'll be doing that because that seems a bit superfluous. But thank you for the suggestion.
I was at a point in time contemplating these, and I was thinking about horizontal and vertical risk management because it's 2 different levels, but it's not. It wasn't really telling anybody anything, so I got it again.
I mean, the names are meaningless. My idea was just to separate into one bucket and the other bucket. I could have called it green and blue. I could have called it violet or daisies and roses. It basically means one is not the same as the other, and unfortunately, one will never become the same as the other. I naively, as the head of risk for the sovereign fund, for 2 years, I've tried to merge the two. I even insisted that we disclose the results of Monte Carlo simulation to the Ministry of Finance, only to be told in the following year is that it's too complex. They don't want to see the reality. They're happy with the heat map, and so the next risk manager came back to the heat map because the Ministry of Finance did not want the kind of the real complex, honest picture of what the risk.
Sometimes you see that. I mean, I have seen other politicians, some Americans and some European, who really don't want to be hampered by facts.
No, well, most don't. Same with board members. They don't really want to know the truth because once you tell, I mean, just for fun, and I mean, this is how corporate world works, I guess, because just for fun, we've decided only once, to disclose the real situation to the audit committee. Just once, just for fun, just to see their reaction. Because we realized once we tell them something, they have no choice but to respond. They have a legal obligation to respond. And my God, they were scared. Like they were just they probably hated us for putting them in the situation where they had to respond and go to the conflict with the management. So yeah, it's interesting. Patrick is asking, is Hans' book available in US? Hans, I believe it is.
Yes, it is. But it is sold out of a Danish website, Danish shop, in English.
The book is in
So you can
English.
buy it. It just takes some time because it's books on demand, so it's printed when you order it.
Yeah.
So that, yeah, but it is available. And I'm looking at some approach of making it into an ebook that I can sell it as a PDF instead, because the standard ebook format seems to be screwing up my tables and my charts and stuff like that, or at least the location of them, so it doesn't make sense anymore. So I have dropped that idea, and I'll find a simpler way of doing it.
Sure thing. Sure. Well, it seems like we've answered all the questions. Thank you, everyone who participated. Separate hello to everyone who will watch this in replay and watch this on Risk Academy YouTube channel. And Hans will share it with his followers as well. Thank you. I hope you found this useful. I certainly did. Like I find every conversation with Hans, that was basically my pretended reason to have this debate. I just wanted to chat with Hans because it's very rare I get a chance to talk with an experienced risk manager who is not convincing me that quarterly risk workshops is the best thing we can do, or some other nonsense about objective risk registers or some other strange things. So thank you very much, Hans, for your time. Thank you for this conversation.
Thank you for inviting me. It's been a good discussion. We had some notes about where it should take, and we didn't go there. But then again, that's what happens. We were risk managers enough to be able to manage the different approach that we ended up with. And I hope also that you, as a listener, now or whenever, will find that it was valuable spending of your time.
Thank you, everyone.